Hi, Faith.
How are you?
Good, thanks. How are you?
Good. So it's the mortgage one, right?
Yes, today we are talking about mortgages and COVID-19. We'll give everyone a couple more minutes to come in.
Okay.
Have a few more people joining us. Um, I do know that this will count for PDP for anyone in Vancouver, the Vancouver board or Fraser Valley board for sure. I haven't heard back from other boards, but if you are on another board, please leave me your information because I am still going to keep bugging them until they answer me. Um,
Yeah.
so if you guys can leave your board IDs and your names in the comments, I need to have them in the chat for them to count. The board's been pretty strict with that, just so that they can verify that you did comment in the actual event. So make sure you leave that there. I can't accept it if it's an email after the fact, if I don't have proof of you participating in the webinar. So if everyone can leave that there. And we will get started in a moment here. Leslie's joining us from Toronto. You may recognize her if you went to our event in Toronto. Was that in the fall, I believe?
October, yeah.
Yeah, October. Time just, I can't even tell time anymore. So Leslie joined us and was very informative then. And so now she's going to come in and give us a little bit of background on mortgages and COVID-19 and answer any questions you guys have. In order for the PDP to count, we do have to hit the hour mark, so make sure you have lots of questions and you ask them all. She's here to answer your questions. And Leslie, you can take it away whenever you're ready.
Perfect. Hello, everybody. Thank you for having me, Brooke. Again, my name is Leslie Tenalia. I'm a mortgage specialist here in Toronto, really focusing on Ontario. As Brooke mentioned, you might have seen me at the event in October speaking about co-buying. I do specialize in that, but I also do all types of mortgages, and I specialize in first-time home buyers. So co-buying and first-time home buyers are very service oriented types of clients, and that's where I like it. That's where my expertise falls. Today, I hope everybody's faring well through this challenging time. We all have our different challenges. I'm at home with 2 kids, a dog, and a husband, going crazy. And then there's other people at home on their own. So everybody has their own challenges. I hope everybody's faring well. And today, my goal is to talk a bit about COVID and the mortgage process, how that has changed, and what to expect for your clients, or what to prepare them for in the changes of the process. I don't know if we'll be able to fill the whole hour on COVID, so I had prepared just some other scenarios that sometimes stump realtors when in different types of purchases. So I thought, if you don't have enough questions to fill the hour, maybe we could do some other scenarios outside of the COVID situation too, Brooke. I don't know if that's okay. We'll see how the time.
That's totally fine.
Perfect. We'll see how the time goes. So first of all, for COVID, we all saw, in the middle of March, our kind of lives implode personally and in the industry as well. I sat there watching, the Bank of Canada decrease prime rate over and over again, and it blew my mind to see what was happening there. And then the fixed rates fell overnight as well. And then within 3 days, they bumped right back up. So there's a lot of instability that we're seeing. With the prime rate, it has fallen. So most lenders, their prime rates right now are sitting at about, or at 2.45. Before COVID, we had a lot of discounts on the prime rate. So they would say you can get a variable rate at prime minus. In fact, a couple months ago, it was prime minus 0.6 and prime minus a point. Because prime now has decreased so low, those discounts really are gone, and they vanished overnight along with all this COVID stuff coming along. And now you're looking at about prime or prime minus 0.1 for a standard mortgage for a variable. Don't be kind of deceived. TD Bank, their prime rate is a little higher, so their starting point for prime is at 2.6 as opposed to all other lenders being 2.45. People ask where the rates are going and what to predict or what to advise their clients. We are in unprecedented times. There are a lot of people out there writing articles about predictions. feel free to read those articles and put whatever weight you want in each expert. I'm not really doing any hedging because as we've seen, nothing really is predictable right now. So we just have to, deal with today, and hopefully it unfolds accordingly for our clients. Over March break, if when we had clients in deals at that point in time, it was really difficult because we didn't know if those clients who've already signed on to a purchase might get laid off, and how would that affect, were the lenders going to be still loaning those ones. And it ended up, thank goodness that they did. They were honoring any current contracts regardless of what happened to people's employment. Now, when you have a client, the main changes that we're seeing with COVID are the rates kind of fluctuating a little. They're pretty much stable, but they do fluctuate a bit. And employment and appraisals. So before you could get an approval from a lender, just with the application, now we're finding that most lenders want documents up front in order to issue an approval. So what that means is they want letters of employment and most recent pay stubs. If your client is self-employed, they'll want their 2 years tax T1 generals along with the application for approval. So this takes time now. So if you have a client who has a finance condition on a purchase, you have to let them know that they need to get all those documents right away, because it's going to delay them getting the approval if you don't get those documents up front to provide along with the application. So that's one of the biggest changes. If you, for example, have a client who works for the Toronto District School Board, and I just know this from experience, they issue letters of employment and they insist on mailing them through snail mail. So imagine you have a client who went into a purchase and there's a 5-day finance condition, and they get the purchase accepted, and so they call up TDSB, Toronto District School Board, and say, I need my letter of employment. They're going to insist on putting it through the mail, and that might take up their whole finance condition days in order to get it for the lender then to review it and issue an approval. So there's a bit of a delay. My suggestion for anybody going in with a finance condition is to try and get it extended as long as possible, just to allow for these differences during this time. Lenders also, some of them will be calling the employers immediately upon getting that review in the application and underwriting it before issuing an approval, just to make sure that the employment is ongoing and solid. If you have a client who is currently laid off temporarily, there are very few lenders that will review that right now and give it an acceptance. So there are some lenders that, on a case-by-case basis, if the client has a return to work letter stating that they are temporarily laid off, in the next couple of months, they will be rehired at their regular salary in their regular position. Then they will look at that and consider it on an exception. So if you have a client in that situation, I strongly suggest a finance condition on any offer, because it will depend on the whole strength of the application, and you won't know again until you get that approval, until it's reviewed. That's one of the biggest changes. The other big change is appraisals. Of course, if you need an appraisal for a property, the appraisers are most of the time not going into the property. What they're doing is they're going around the property, looking on the exterior, taking pictures of the exterior, trying to get any information they can off of MCAP or MPAC or whatever access they have for database online, and also asking the current owner to take pictures or submit pictures and submit the rooms and the sizes and the square footage. So you're relying on the seller also to have that information up front. So appraisals are also taking a little longer, because it's not just about the appraiser going in and doing what they normally do and leaving and writing a quick report. You can usually get all that within a day. So it might take a little longer depending on the seller having the information up front to provide to the appraiser at the time. So really, that's what I'm seeing right now. The differences, again, it really comes down to extending your finance condition. Just to allow for this. And some realtors have come to me and said, oh, I don't know if that's possible. I can't get like 6 or 7 business day finance condition, and to their surprise, they've been able to, because sellers are also aware that these are unprecedented times. I know in Toronto, the first 6 weeks of the sales went down, but I don't know if you've noticed recently, there has been a lot more activity. I think people are realizing, if they have solid employment, that this is the way it might be. And if they were in the market before it happened, they're revisiting the options again now. So there's a lot more activity. I think that, we had a short period of time where there wasn't a lot of multiple bids on purchases. I think that's going to come back in the coming weeks. So here I am saying you need to finance conditions. I understand the predicament realtors find when they're up against multiple bids. But that's something then to really discuss with the mortgage specialist. If, how solid is the application? Can they go in without the finance condition? It really is coming down to employment right now. So, any questions at this point?
We have a question in the chat from Deb asking how long for a finance condition now. So I guess, like, what's the length you could extend to?
As long as the longer the better at this point, because there's so many unexpected things. So normally when I have clients, I try to get a 5-day. That kind of allows for enough time to get what we need to do. In this time, it depends if your clients have their documents all together. If you get the accepted offer and the client has their letter of employment, that has to be under 30 days old. Okay? It can't be an old one from 2 or 3 months ago. It has to be a recent one. And they have a recent pay stub ready to go and to give their mortgage specialist to get that approval right away. Then, the 5-6 days, okay. But if they have to go to their HR department, ask their HR for that letter of employment, until the mortgage specialist gets that letter of employment, they won't get the approval. Back in the day, we used to get the approval and then be able to submit the documents after the fact. So, my suggestion is, as long as possible, 6 or 7 business days is great, but it does depend if the client has everything ready to go.
Perfect. Any other questions?
No questions?
Doesn't look like it.
Okay, that's totally fine. I get it. So, and I was, there's not much to say, about COVID, except for those main points in my experiences. So that it's changed a bit, but not that much, and not enough to fill 1 hour. And I believe you need it for the purposes of Sutton. So why don't I then, if it's okay, Brooke, go over some other just scenarios that I find that sometimes we come into trouble with mortgages and purchases. Is that okay?
Yeah, that works.
The first one is, I get a lot where whether a client comes to me and they want to put an offer in on a purchase, and it's then discovered that they are in the middle of a separation from a legal marriage. This is something that sometimes realtors aren't aware of, is that if a client is in the middle of a separation, there's some issues to look at before actually even starting the house hunt with them. And that would be, for example, the lender wants to see that separation agreement. So they won't approve a mortgage if they know a client is in the middle of a divorce without a separation agreement. So, sometimes separation agreements can take a really long time. Sometimes clients think they're almost there and their ex-spouse is ready to sign, and then they don't. The reason that lenders want to see that separation agreement is because when they approve somebody for a mortgage, it's all done by ratios. And in the ratios, it's debt to income. In the debt portion of that, if your client upon separation is gonna owe spousal or child support, they want that monthly liability included in those ratios. So that's why they want to see the separation agreement, to make sure that there aren't any spousal or child support owing. And if there are, how does that affect their ratios? Often that spousal or child support will decrease the amount they actually qualify for. So I've seen where, unfortunately, I haven't been able to get mortgages for people because it just, that support payment just kills what they can qualify for. So that's why lenders really want to make sure that they see the separation agreement. In some situations, if there's no children involved, some lenders will give you an exception to having that separation agreement. That exception is if the client and the client's ex-spouse or soon-to-be ex-spouse will sign an affidavit with the lawyer stating that upon separation and once it's final, there'll be no spousal support required going from your client to out. So if they're getting some, that's okay, that's great. But if they're going to have to pay out, so that's what the lender wants to make sure they're not having to pay out. So if your client will sign an affidavit, and sometimes it'll be required that their soon-to-be ex-spouse will sign an affidavit to that effect, you can get possibly an exception to having to wait until the separation is completely final in order to get a purchase. Now, what will happen is that they will speak to a lawyer to do this. Some lawyers will say, no problem, sure, sign here. I, so-and-so, do not expect any payments from your client as at the end of the separation agreement once it's final. But some lawyers will say, no way. They will say, well, I'm not going to get involved in a family court situation, and I don't think it's safe that I make somebody or I ask somebody to sign an affidavit if they don't fully understand. Maybe the spouse doesn't realize, the soon-to-be ex-spouse doesn't realize what they can get. So if they sign away this affidavit, then that will ruin their chances down the road of actually getting anything that they might deserve that they don't know that they deserve. So depending on the lawyer, they may or may not do it. And I always, in that situation, suggest independent legal advice. The other thing is that an example the other day, I had a client who didn't have a written separation date. So that separation date states that as of this date, anything acquired is mine and mine only. Anything before this was part of the marriage. They had a verbal separation date, but not one that was written and documented. And so what I had to say to that client is, well, I don't know then, if you buy a house now, before the separation is final, is that now part of does that get incorporated then into your separation? You might have a verbal separation date, but you don't have a written separation date. So again, go speak with your lawyer before acquiring any new property during this kind of limbo time. That's an important note for your client too. You want to make sure that they're not buying something that's going to be, have a risk of their ex-spouse getting it because that separation is not final yet. So that's one. If there's children involved, then absolutely the lender will demand that they see a separation agreement, and that's because they want to see what child support is owed either way and how that fits in to the application as a whole. Are there any questions about that kind of scenario?
I have a question in here. Right as you started, there was a question from before. So that is there any professions like teachers that have hang-ups like getting letters of employment? So do you know of any other professions that kind of have that same issue?
So the teacher one is my biggest one that I've had the most difficult experience with in getting those letters of employment. Right now, it's hard to know because I find that getting in touch with HR departments, when people shifted from working in an office to shifted to working from home, some businesses, technologies, or the setup isn't that efficient. So for example, even for my own profession, getting in touch with some underwriters, I can't call them because their phone system doesn't work or attached to their home. So the only way to get in contact with them is through email. So it's not really industry specific. That is one example that I know of challenges for sure. But with everybody working from home, and it depends how their office is shifted and how their technology is, people are harder to get a hold of for sure right now in general. So this is why when right now people are looking to buy, it's just really good to warn them up front. If you really see something that you really strongly feel you're going to put an offer or want to offer on, start getting your documents now before any kind of offer really goes out. Again, as long as those documents are under 30 days old, they can be used for the application.
Perfect. We have another one in here. Sorry, let me just read it quickly.
Oh.
Okay, so they're wondering if people are buying investment properties, since rates are pretty good, how and where can they get an easy, no hassle approval with being self-employed?
Okay, being self-employed doesn't, it's okay. If you have somebody who's been self-employed for over 2 years and they have those T1 generals, they will be able to show their income with, looking at averaging it out over the last 2 years, depending on when lenders are looking at self-employed people, they're looking to make sure of a couple of things. One, that is their income's on an upward trend. So if the most recent year of their T1 generals is lower than the previous year, they're going to use a lower amount. If there is an upward trend where the current year is higher than the previous year, they're going to average those two out. With self-employed, depending on the type of self-employed, we can also gross up that income, which means we all, are self-employed here really, and we write off as much as we can to lower that amount that we owe for taxes. And lenders know that, and so you can gross up their income by 15%. So you can kind of top it up a little. It doesn't make up for everything that we write off, but it does boost it up a little. So there's that. There is really no hassle mortgage right now. Again, employment is a big deal. So for somebody who's self-employed, what they'll do is they'll still look at the T1 generals, but they'll probably ask for more documentation. So even though in 2019 and 2018 your business was doing really, really well, that's great, but we know that maybe right now your business isn't doing well. So they'll look at, they might want invoices, of current invoices, recent invoices that you've issued and that have been paid, to show that you still have some business. They might want to look at your bank statements to see, business bank statements, to see that you still have you're generating income on a regular basis, that your business is still viable and still doing well. So there is no hassle right now. Self-employed, they will look at the history and they'll also look at right now the current situation.
Awesome. The next question we have here is it hard to get pre-approval right now?
So pre-approvals depends what you mean by a pre-approval. A pre-approval right now, you can still get pre-approvals. But a pre-approval does not mean that you're approved. And they're not really underwriting them the same way they used to, which means is that they'll look at the information on the application, but they're not reviewing documents. They're not asking to see, the employment documents and the pay stubs and the letters of employment. They're just saying, okay, so as long as all of the information on this application can be backed up at the time you make a purchase and backed up by way of documents that we approve of, then we will provide you with the mortgage. So a pre-approval really is not a guaranteed approval. That can only come at the time of the actual purchase. And that's because the property is the collateral for the loan. So the lender wants to not only review the documents from the applicant to confirm that everything on that pre-approval can be backed up, but also the property itself, right? So it's also about the property, make sure the value is correct, make sure it's a 98% complete. And so a pre-approval can still be gotten. Again, it's a budgeting tool and a rate hold. Beyond that, it's not a guarantee.
All right, another question in here. They're wondering how the lack of strata insurance is affecting mortgage applications. So I'm sure you get that one a lot recently with all that's going on. So they're just wondering if an old strata building is up for insurance renewal in a few months, would buyers be having difficulty getting financing?
Yeah, I haven't gotten that question a lot, but it's a fascinating situation that we're in with that. And I've been reading a lot. I know Vancouver, it's pretty crazy, and it is coming here with these issues with the strata insurance. Absolutely, if a client is looking to purchase, or if coming up even for renewal of a mortgage, there might be issues for sure. Now, what happens, of course, when you have a condo purchase and the lawyer is reviewing the documents, it'll be up to the lawyer will inform then the lender once they've reviewed the strata. documents where about the insurance and how much time there is left in the insurance and when it's being renewed, and of course the reserve fund and all those other fun things. Strata insurance is going to be an issue. My understanding is that, you know, there's been leads to the Insurance Bureau of Canada to fix this, and that it will, you know, they said that they're looking at it and they're looking to fix it, but it's not a quick fix. So what's going to happen in the meantime? It's going to be a tough one.
All right, a couple more questions in here. So the next one is about renewing current mortgages, and they're wondering if the bank will be penalizing those who defer their payments during COVID. And then there's also a follow-up, which I'll ask you after.
Sure. So renewing current mortgages. So the question is there a penalization for deferral? Is that the question? Sorry. Okay. No, they're not going to penalize. I mean, we hope they don't penalize. The expectation is that they won't, because this is actually these mortgage deferrals that started being utilized highly over COVID is actually something that they offered before. They just didn't advertise it so much. So there's always that option to defer your mortgage payment if you came into you know, some issues. They would review and make sure you fit into the reasoning why you're requesting for the deferral. It wasn't usually a long-term deferral. Maybe it would have been a month or maybe 2 months to defer. So this is actually something that they did have before. It just became, for obvious reasons, more in the forefront over COVID. Now the issue, I haven't seen it yet, but I've heard in the past and before COVID, when people deferred their mortgage payments, my understanding is that it actually went on your, well, in some situations, it was spotted on the credit report. So it's not supposed to affect your credit. It's not supposed to be reported to Equifax or TransUnion that you've deferred it. But in the past, there have been situations when a client deferred their mortgage and the lender didn't, the administration of it wasn't done accordingly, and then it looked as though they missed a mortgage payment. So there's question now if that's going to happen in the future. All these people who have deferred at this point in time, is it going to go on the credit? So in the future, if it does go on your credit report and you do see in a future application that has been there, my understanding is just an explanation that was COVID. We all know the dates of COVID, so they will be able to see that happened during COVID and that was a mortgage deferral. So are you going to be penalized for doing that? No, but if it actually hits your credit report, there might be some issues there. So maybe if you have deferred at this point, once in the next few months, my suggestion would be to check your credit and see if it did hit your credit report and get on that right away, and just ask your lender then to write a letter, so you always have it on file, and call TransUnion and Equifax and see if you can get that disputed and removed. There is a process. It does take time to do so. So the sooner you get start the process, the sooner you'll have that resolved.
And then the follow-up question is it true that lenders are offering 6 months as a maximum deferral period?
It's all very lender specific. So every lender has different guidelines for it and has different ways of fixing it and what they're doing with that payment and how whether they're gonna add interest or not. And the 6 months, it depends on the lender. Right now, everything's in flux. They might extend it if COVID continues on. If we have a big second wave that creates another kind of shutdown, hopefully not. But if it does, they might extend that, your lender. Everything is so fluid right now that I don't want to say yes or no to that.
Awesome. We have no other questions, so I guess if you want to move on to your next topic, and then if any more come up, I'll let you know.
Perfect. Sure. Thank you. So for the next,
right as you started, it says, how long are most pre-approval rates holds good for?
Yeah, good question. So they are, for the main ones, they're between 3 and 4 months. For First National, a lot of the banks, they're 120 days, so 4 months. And what that means is that you actually have to close within that 4 months. So it's not good if someone's going to be like just start looking in 2 months or 3 months and then close in 6 months. It's only really useful if they're going to close within that time, and then you can extend it after the 4 months, but it gets extended not at the original rate. If the rates have crept up a little over that initial 4 months, it'll be extended at the rates at that time for the next 4 months.
All right, thank you. That's the last one in there, so you can move on to the next.
Excellent. Okay, so my next scenario is, I run into this a lot just because I do a lot with co-buying, so it's generally the type of purchase. But what some realtors don't realize is that if there's a client wanting to buy a fourplex, so a multi-unit fourplex, whether it's for investment or to occupy, what have you. If you have a purpose-built fourplex, 4 separate units, and they've slipped in a 5th unit, let's just say in the basement, although it's registered as a fourplex, not a 5-plex, when there's 5 units, it becomes a commercial mortgage. So you're going from residential, even though this specific fourplex is only registered as a fourplex, which is a residential mortgage, that extra little 5th basement unit turns it into a commercial mortgage because it's about the intent of use. So commercial mortgages are very, very different from residential mortgages. So it's just something to be aware of, that if you are showing a place that is a fourplex but does have that 5th unit, that the client will be looking at a different process than the regular residential mortgage on a multi-unit. It will come down to, there was just a personal experience of one of my experiences with this. It was a fourplex, but it had this little basement kind of bachelor, and that little basement bachelor had a dinky old kitchen in it, just some old cupboards. It was not very, very big. And when you walked up to the front, up the front steps of the main house, you would see 5 doorbells, right? So in order to avoid having to go to a commercial mortgage as opposed to a residential, we actually ended up taking off the doorbell. So there's only 4, taking out the basement kitchen and just making it kind of look like a rec room. And it went back to a fourplex because it had 4 kitchens. That basement dinky kitchen turned it into a 5-plex. So that was a 5th kitchen. So that's one thing also to be aware of when you're looking at different types of purchases. I think there's a question.
Yeah, there's a question in there now. So it says, if zoned for commercial, if zoned for commercial and home has been lived in and totally looks residential for years, can a residential mortgage be obtained?
Frustratingly enough, no. So it's almost like the default's commercial in a way. So you have a fourplex, even though it's zoned fourplex and it's got that 5th, unit, it goes to default of a commercial. If it's a commercial property, although used and I had this exact same thing, used and looked like, a home, a single family dwelling, but it was in kind of more of an industrial area of town. So therefore it was a default of the commercial zoning. It's still a commercial mortgage. I had this problem with an amazing looking property in a bit of a more of industrial part of town. And so it used to be an old garage or something, and they switched it into an amazing, like totally modern building, single family home. And I couldn't get it done on the residential side. It had to go commercial because it's zoned as commercial, unfortunately. So. Any other questions?
The main difference with a commercial mortgage over a residential mortgage.
Okay. So a couple of the main differences. First of all, when we're talking about, for example, a finance condition, you want a much longer finance condition. So you want a minimum of 3 weeks for a finance condition for a commercial mortgage. What happens is you don't get an approval for a commercial mortgage until there's been an appraisal and until usually CMHC reviews the file. Most commercial mortgages are, most multi-unit, residential commercial mortgages are covered by CMHC. So you don't even get the approval until an appraisal. CMHC has reviewed it. Often CMHC will not agree with the appraisal, so there might be some more digging, more research done. So that finance condition has to be much longer. The other big difference is the viewpoint of the lender. So for a, sorry, my dog's barking in the background there. For a, let's just say a fourplex, and the owner is going to occupy one unit and rent out 3 of them. They will look at the purchaser's ability, along with the other 3 rental incomes, to support the mortgage payments every month. When it comes to a commercial mortgage, they're looking at the building itself. They don't, the purchaser is a guarantor for the loan, but they're looking at the rent roll. They want to see that the building itself can generate enough income on its own without the purchaser's employment and income and all that. So they're looking at it from a different point of view, and that's a big thing. There is more environmental documentation, survey documentation required, and the process itself takes longer. So where you might be able to close a residential purchase in 3 months, 2 months, this type of purchase would take 6 months and then some to do. So those are the main differences.
Okay, another question just got put in here. So due to COVID in Tennessee, a tenancy law in BC, there is a rule against evictions right now. Does that affect financing applications for investment condos?
For investment condos, I'm just trying to think. For an investment condo, I guess it would depend on the circumstances. So you're not going to own or occupy it. So you're not stating up front that you intend on moving in, and they're utilizing the current rent. It depends on the situation. If you're using the current lease as to support the application, then it shouldn't, but there's a lot of different pieces there. An example would be right now in Toronto, some people have bought a triplex, and they are supposed to fully own or occupy the triplex, but some of the units, the tenants are refusing to leave because of COVID. And so because of that, then the current owner has to live somewhere else, and now we have to use the current owner's rent as a monthly liability because they can't move in until that person leaves. So there's a lot of different, it would depend on the specifics. If the current tenant in an investment condo is going to stay anyways, it should be okay. If you're trying to have them leave because they're only paying $1,500 for rent, and you're utilizing, and assume $2,200 for rent for the purpose of the mortgage, and that's no longer going to be the fact, then it can affect the mortgage approval. So there's a couple things that might influence either way. If you have any questions about the specifics, please feel free to contact me. We can review that.
So if in that case they had a tenant that wasn't paying due to COVID.
Oh, sorry, I misunderstood. Wasn't paying due to COVID. Again, it's hard to know if you're utilizing that rent in order to support the application and qualify for a mortgage. Depends if you used an appraiser, if you had an appraiser go in and determine market rents, so market rents being what you could rent it out for. If you use the market rents from an appraisal, then it shouldn't affect it. If you use the current tenant's lease, I don't think it will affect it because they know this is a temporary thing. If the lenders all of a sudden said, we're not going to honor our approvals because of this current situation and current unprecedented elements that might change, I think everything would fall apart. So I don't know. Again, if there's some different elements that might change my answer, if you want to email me, I'm happy to review it a little more. Yeah, that's a tough one.
Okay, perfect. So the next one is, do you know if banks foresee an increase of court order sales?
Well, I mean, I know there's going to be more defaults. So there's going to be, I think that, I mean, that's the writing on the wall. That's what they're saying. It makes kind of common sense. Depends how long this goes on for, how many you're seeing. You know, a lot of people are losing their businesses. And I do know, you know, some people whose businesses were tied to their mortgage or tied to their own personal situation, and they've lost their homes. So I think there's definitely an expectation that we'll see an increase. To what degree? I think it depends how long this carries on for.
And then back to that investment condo question, they're asking if the bank will ask for rent deposits as proof of the tenants paying when they're looking into mortgage.
No. So that's where I don't know. I don't really want to say no, this won't affect it, because I would like to look at the whole thing, but they don't ask for proof that the current tenant is paying. And that's why I was saying it depends if you use market rents or a current tenant's lease. I've never had it where they're asking to see those deposits. Again, we are in unprecedented times, but I don't think that's the case.
All right, perfect. Doesn't look like there's any more questions in here just yet.
Okay, perfect. So I had a couple more scenarios I thought maybe would be useful. And one of them is about changes that occurred back in 2017, I want to say. And it was on the back end. Before 2017, if a client came to me and said, what's your 5-year fixed rate? I could just say, oh, our 5-year fixed rate is 3.09, done. Now I have to get them, ever since 2017, there's been changes to CMHC's guidelines. And because of that, I have to get more information. So, you know, credit rating will affect things, but more so, they've changed it from being a mortgage that has 20% down and a mortgage that has less than 20% down. So an insured mortgage, which has less than 20% down, CMHC insured, and a mortgage that's not CMHC insured has more than 20% down. They've changed it from that to insured mortgage. So it's a mortgage that has less than 20% down and fits within the CMHC guidelines. Insurable mortgage, which is actually people who have more than 20% down, so they don't have to get it CMHC insured, but it still fits in within the insurer's guidelines. And so the lender decides to insure it on the background. This is really important. So even though the client has not paid the insurance premium, and for all intents and purposes, it doesn't look like an insured mortgage because they have more than 20% down, it still might be insured on the back end. And uninsurable. So an uninsurable mortgage has more than 20% down and does not fit into the insurer guidelines. And just to quickly go over the insurer guidelines, the ones that really, the big ones would be a purchase of more than $1 million. Okay, so any purchase in Toronto or any purchase in Canada that's more than $1 million is not insurable right off the bat. If you have a 30-year amortization, so if you have 20% down and you choose a 30-year amortization instead of a 25, it's not insurable right off the bat, even if the purchase is under $1 million. And another one is if it is not owner occupied. In order for it to be CMHC insured, it has to be owner occupied. So that's the key as for my next scenario. So before 2017 and these changes came in, you know, if we had a client who wanted to live in a property, a single unit, let's say it's a condo, and then, but maybe down the road in a year or two, they might want to move into a home and keep the condo and rent it out. That wasn't a problem. They could change their mind midstream. But with the new guidelines, because CMHC insists that any rental unit is owner occupied, immediately condos are not insurable. And if a rental unit has to be owner occupied and a condo only has one unit in it, it's not like a duplex where, you know, one person can rent one unit out and live in the other unit. So off the top, a condo investment is not insurable. And so I found that some realtors were saying to their clients, oh, that's not a problem. You can get this condo, live in it for a year, and then rent it out. But that plan can work, for sure. They're allowed to change their mind if it's not insured. If it is insured, it can become an issue. And this is where that insured and insurable comes in, because many purchasers don't realize that they've purchased a condo under $1 million. They've chosen a 25-year amortization. They've said that they're going to live in it and not rent it out. And the lender has insured it in the background. So they don't know that necessarily. And then they go to switch it from an owner-occupied condo to a rental. Well, they decide, well, I have to let my insurance agents know that now I'm moving out. I'm going to rent out my condo. The insurance for house insurance, for home insurance, and they say, well, maybe I want to get some tenant insurance in case the tenant, you know, causes a fire or something. So then they make their insurance company aware that they're renting it out. The insurance company has the obligation to inform the lender that the unit is now a rental and not an owner-occupied property. And so what happens then? Because if this is actually insured, then it now doesn't. It's not insurable anymore. So what? Depending on the lender, depending on the circumstances, depending on how much time is left in the mortgage, you have to be aware that if a client is intending on renting that property out down the road, that if the insurance company informs the lender that it's now a rental property, the lender might find out and now say they want to change the elements of the mortgage and that they have to remortgage the property. So it's just something really, really important to know. If it's not insured, it's not that big of an issue. But if it is insured, it can be an issue. So just something to make sure that your clients are aware of. Are there any questions about that?
We have a couple questions in here. So first one is, what is the current loan to value the bank is comfortable with for rental condos? And is it still possible to get a 30-year amortization for a rental condo?
Right. Okay, so for the rental condo, they're going to want probably 35%, 30 to 35%, depends on the lender, 30 to 35% down for the rental condo. You cannot, if you're placing the deal as a rental condo, it's a single unit, non-owner occupied rental, which therefore means it does not qualify to be insured. And that means you cannot get insurance for it. And so therefore you can use a 30-year amortization.
Perfect. Then we have a couple more questions in here. Is the qualifying rate for the stress test expected to come down? Yeah, so that's, I think that might be different depending on the province you're in. Is that correct?
No, it's Canada wide. So when stress test first came out, originally it was 5.39 was the qualifying rate that we had to qualify everybody at. It has since come down to 5.04. So it has already come down a bit. Before COVID happened, things were up for negotiation. They were talking about doing, it was supposed to start in April, a whole different type of calculation for the stress test qualifying rate, and then all of this happened, so they put a pause on that. I think that once things stabilize, that will come back again, and then it will bring it down a little bit more. Let's just say from 5% down to maybe 4%. The difference wasn't massive, but it was, back then it would have brought it down to about 4.79, I want to say. So there's about another quarter point lower. So once things stable out, I think that they might utilize that calculation again. I'm hoping so anyways.
And the next question is, would the bank not have an obligation to tell the condo owner up front that they have insurance on the property on the backside?
And that's a really, really valid question. I think it really is my responsibility as a mortgage specialist, in my mind, to fully educate my clients and let them know and have those conversations with them. Okay, what is your intent? And educate them in that matter, the differences between the different types of mortgages and what might happen on the back end that might affect them or their options. So that's something that I do my best to do and fully educate my clients. That's me. The banks, I often find, and I don't like to speak poorly, but I often find the people in the banks aren't there to fully educate their clients. And I've had it where people come to me, oh yeah, I'm pre-approved, and I say okay, and then they tell me more about their situation. This happened last week to me, with a client. Okay, well, did you tell the bank? Does the bank know that you have these payments? That well, no, they didn't ask. So I just find it's not as comprehensive of an experience with the banks. So it really is my responsibility as a specialist to fully educate my clients and talk about their options and understand what their goals are with the property, and then I would inform them for sure.
All right, next question is, any changes to the minimum down payment required for a residential, and does a larger down payment of 50 to 60% make it easier to qualify for a mortgage?
Valid question. So there's no changes to the minimum down payments. And so the minimum down payments, is incrementally goes up. If it's a purchase of $500,000 or under, the minimum down payment is 5%. If it's a purchase above $500,000 but below $1 million, that portion of the purchase is then 10%. So up to $500,000 is 5%. For the purchase price portion above 500,000 to $1 million is 10%. You add those together. So an example of a $600,000 purchase, for the first 500,000 of that purchase is 5%. That's $25,000. For that extra 100,000 to bring the purchase to 600,000 is 10%. That's another 10,000 on the 25. So that's $35,000. The down payment over $1 million is 20%. And this is what often some people don't understand or don't realize. After the purchase price of $1,250,000, there's a sliding scale for most lenders. So up until 1.25000 is 20%, but some lenders then charge for the portion above that amount 50% for the down payment. So again, for the purchase up to $1,250,000, that'd be a $250,000 down payment. But if it was 1.350, for that $100,000 portion over, it's 50%, and that's an extra $50,000, not 20%. Now, often you can get exceptions to that rule. There are some lenders that will do 20% up to $2 million. So these are conversations to have and be aware of. And then having more of a down payment doesn't increase how much you qualify for, but it strengthens your deal. So it's one of the elements they'll look at, the loan to value. If the loan to value is 95%, although acceptable if it's under $500,000 purchase, it's a bit of a weaker deal than a loan to value of 80% or 70% or 60%. It strengthens the whole deal, but it does not qualify you for more money.
Thank you. There's no more questions. We have about 7 minutes left. So I don't know if you want to do your last scenario.
Sure. I have one quick scenario left. And it's the time of year when maybe I don't know if cottages are really going up for sale or if there's a pickup up there. I guess we're not even allowed to go to our cottages right now. But it's about a cottage property. And this comes back again to the insured, insurable, and uninsured kind of idea. when you are taking a client to see a cottage property, there's different factors. You can have the most solid client and that has great income and no debt and great credit. So as applicants, they're amazing, but it might be the property that's an issue for the lender. Some things that lenders are looking at when they're looking at the properties and they might have issues with, especially for cottages, is it a year-round cottage? So does it have a heating system? If not, that's fine. There's lots of seasonal cottages out there that are very acceptable. Does it have road access? Okay, so if it doesn't, if it's a seasonal cottage that's not winterized and doesn't have road access, it's only got boat access, then we kind of call that with a B-type property. And some lenders won't lend on B-type properties. Not to say that there are lots of lenders that will, but it does decrease the pool of lenders that people have access to. Namely, I mean, Scotiabank is one of the best ones for the B-type properties. So if you have a client looking at something that, you know, it might be an older property up north and it doesn't have road access, you know, tell them to explore Scotia or call me. I'll call Scotia for them. Something really, really important to note, though, and this is why I bring up Scotiabank, is they'll be looking at potability. Is the water potable? Meaning, is the water drinkable? So if it's coming from a well, or if they're bringing the water in from the lake, they want to make sure there's a filtration system on there to make sure there's no E. coli in the water that can harm somebody or kill somebody if they were to drink the water. And that's really the reason. Title insurance is hard to get if the water is not potable. However, there is a little known kind of way around that, so if you have a client who is looking at a property who doesn't have potable water, that's something to be very aware of, and then make sure they are speaking with a mortgage specialist who knows this kind of way around that. And the way around that is that Scotiabank will actually allow an exception for the water not being potable upon request. And that is Stewart Title, which is a title insurance company, is the only title insurance company that will provide title insurance on a property without potable water. So it's basically requesting the underwriter upon submission of the application, okay, this property does not have potable water. Can you please make the exception that the lawyer, instruct the lawyer who's doing the closing to make sure he goes through Stewart Title because the water's not potable. So if they know that way around it, then you can get a mortgage. If they don't know that way around it, the water's not potable, you can't get a potability certificate, you won't get a mortgage on that property. So that's the other kind of scenario I have.
All right, we have one question, but not related to that. It says, among the big banks, HSBC, BMO, BNS, TD, which one is favorable in lending to rental condos?
So I don't have access to any of those except for TD. So I don't know the products that the other ones actually offer for rental condos. TD is an excellent lender. They have excellent mortgage products. I'm just trying to think. This rental condo, when all of those lenders, I would think would lend on that. I don't see an issue with having the rental condo, so long as you have enough of a down payment. What you have to be aware of when it comes to rental condos, they're not insurable, and you will pay a bit of an extra bit on your mortgage rate. So any kind of rental investment property will come with a bit of it. It might be, depending on the lender, it might be 0.15% to maximum 0.5%. I mean, to a quarter point higher than the standard mortgage rate. So I think they would all do it. You might want to investigate who's got the best rate for an investment property.
And then we have another question here that says, ever heard of Manulife One?
Yes, Manulife One. Manulife One, I've sat down with the underwriter and we've gone over the product. I've never utilized it, and not for it being not a good product, but more so because I have troubles explaining it to my clients. because what it is, it's actually it's a really smart way of doing it. And I wish that there was a bit more maybe material to help me explain it to my clients, in that it's one account. So there's ins and outs. You can use the account as, where your paycheck gets automatically deposited into. And this is the same account that contains your mortgage loan in it. So let's just say your mortgage loan is $100,000, and every month you are utilizing this account as your checkings. So every month you have a debt of $100,000 in here, but yet you're putting in your monthly or your biweekly paycheck into here. And so at times during that month, your balance is actually, or your debt is actually lower because you put a deposit, even though you're taking out. But for that day, it's the way that the interest is calculated, and you can see that I'm not even having problems trying to explain it. For portions of the month, your mortgage balance actually is lower, because you would have deposits in there, and you pay for your groceries and everything during the month. But if interest, it's the way they calculate the interest on that, you can actually decrease the interest that you pay over the life of the mortgage because of those temporary increases in the balance, which decrease your mortgage and then the way the mortgage interest is calculated. So yes, I've heard of it. I've never arranged one because I find it hard to explain, as I've just proven to you. And I think it's a really good product, and I wish I wish I could explain it better for my clients to have that advantage.
Perfect. Any other questions? It doesn't look like it so far. I'm going to put your email in the chat, so if anyone has any other questions or wants to contact you for a mortgage, they can.
Oh, perfect.
So that's in the chat now. Just a reminder to everybody that's in here, if you want the PDB credit, I do need your information in this chat. It will not count afterwards. And other than that, thanks for joining us, Leslie. Do you have any closing remarks?
No, I just want to say thank you for having me again, Brooke. It's always a pleasure. Unfortunately, I'm a bit of a nerd, so I could talk about mortgages all day long. So this is actually quite fun for me. And I hope that everybody stays healthy and safe. And if you have any mortgage questions, please feel free to contact me. And I'll do my best to provide you any answers. So thank you.
Awesome. Thanks so much for joining us.
Thank you. See you again soon, I hope.
Yeah.